that you might be eligible for on the tax return. So that's very different than a deduction. Excluded income retains its non-taxable character without regard to the amount of the taxpayer's gross income. Now, most types of excluded income does not have to be reported on the tax return. If it's excluded, most of the time, you don't need to report it. But there are some notable exceptions, like municipal bond interest. An example of excluded income that doesn't have to be reported at all is life insurance proceeds. If, for example, your mom dies or your dad dies or your brother, and they have a life insurance policy that pays out to you, then the life insurance proceeds that you receive are not taxable. Life insurance proceeds are not taxable to the recipient. And that's something that doesn't have to be reported on your tax return at all. The life insurance proceeds themselves. That's excluded. Now, non-taxable income sometimes has to be reported on the return, even if it is excluded. And the best example of that is municipal bond interest. So if you get municipal bond interest because you purchased muni bonds, that still has to be reported on your tax return, even if it's not taxable. You still need to report it. Example, Marcus is a popular recording artist who earned more than $2 million of taxable income during the year. So he's like a musician, and he's making $2 million a year, which means he's at the highest tax bracket. So he's going to be phased out for most deductions. He's not going to get them because of his AGI. Now, because of his high income, many deductions and credits are phased out for him. However, on July 1st, Marcus is involved in an auto accident and sustains major injuries. Marcus sues the other driver and receives an insurance settlement of $95,000 related to his injuries resulting from the accident. The settlement is excluded from his gross income because compensation for physical injuries is not taxable to the recipient, regardless of his taxable income level. Marcus does not have to even report the injury settlement on his tax return. So that's an example of excluded income where this would not have to be reported at all on his tax return. And we talk more about injury settlements and legal settlements later. Just realize that this is the difference between excluded and deductible. This is excluded, doesn't have to be reported at all. Calculating taxable income. Now, gross income is all the income that a taxpayer receives in the form of money, goods, property, and services that are not exempt from tax. In addition to wages, salaries, commissions, tips, and self-employment income, that's all earned income right there, that list. Gross income includes other forms of compensation, such as interest, dividends, capital gains, taxable fringe benefits, and stock options. And some of these can be partially taxable. One example of that is taxable fringe benefits. Sometimes you'll have someone who's receiving a fringe benefit that is partially taxable. Okay. Next, the taxpayer calculates their adjusted gross income by subtracting from gross income certain deductions or adjustments. These are AGI adjustments. They're commonly referred to as above-the-line deductions, and these will actually reduce the taxpayer's AGI. And this is different than a tax deduction that you would take on the Schedule A after the fact. So above-the-line deductions will reduce your adjusted gross income, which is why they're so beneficial sometimes if you're trying to get the taxpayer to either qualify for a certain credit or lower their the payback of their APTC, which is the advanced premium tax credit. The above-the-line deductions is where you can kind of make magic happen sometimes, and we have a whole webinar just for those. Congress seems to mess with the above-the-line deductions every single year, but above-the-line deductions are different than deductions that are taken on the Schedule A, okay? And then the amount of a taxpayer's AGI is important because it helps determine eligibility for certain deductions and credits. How to calculate taxable income and tax liability for most individuals. So you start with their gross income, all their wages, their rental income, the income from their business, all of that goes at the top. That's one big bucket. That's the gross income bucket. And then you subtract adjustments to income, which are the above the line deductions, and then you get your adjusted gross income. And this one is the magic number, that AGI number, because that's the number that you use on a FAFSA. That's the number that you use to figure out whether or not the taxpayer qualifies for certain credits. This number, the AGI number. And then you subtract the greater of itemized deductions or the standard deduction. That comes after the calculation of adjusted gross income, and then you get your taxable income, and then you get your tax rate. Okay, tax rate is the tax rate that you're going to pay on the taxable income that you have. And then you get your gross tax liability, that's how much you owe, and then you get to subtract your credits. Okay, the credits come after, the credits are last. Okay, the credits are not a deduction, the credits are a credit against tax. They're treated like a payment. Okay, so this is how it works on the tax return. And if you print out a tax return, this is exactly how it goes on page 1 and 2 of the Form 1040. And then what you get last is you either owe, right, or you get a refund. Okay, that's how you calculate it on the tax return. Earned income versus unearned income. Okay, so earned income is income that you make from work. It's earned. You have to have earned income in order to claim the earned income tax credit. Now, most of the time, earned income is pretty straightforward. It's wages, salaries, tips, professional fees, or self-employment income received for services performed. Earned income is generally subject to Social Security and Medicare tax, which is also called the FICA tax. Now, when you pay Social Security and Medicare taxes, that goes into your Social Security and Medicare tax fund. Nobody wants to pay Social Security and Medicare when they're young. When they get older and they get closer to the point where they're going to claim Social Security, a lot of those retired people or being close to retired get a little panicked because they'll go into their Social Security account and they'll pull their Social Security statement and they'll see that their Social Security is going to be some piddling amount because they spent their whole life trying to avoid paying Social Security and Medicare taxes. Many times people who are like making money under the table, that sort of thing, they regret not paying these through their lifetime. Because even missing a couple of years where you're not paying any Social Security and Medicare can make a huge impact when you actually do go to retire and start to get Social Security. Usually the time when people start to get a little bit panicked about this is when they hit like 55, 60, and then they pull their Social Security statement and they realize, oh my gosh, my Social Security is going to be like $600 or $900 because I wasn't paying Social Security and Medicare, or I was trying to avoid doing that. Earned income is where you get Social Security and Medicare taxes applied to what you earn, okay? And this is the type of income that you need in order to claim the earned income tax credit. You have to have earned income in order to do that. Unearned income is basically the other bucket. It's everything else. And sometimes unearned income can be taxed at different tax rates. And this is what I think seems to confuse people, because unearned income can be ordinary. So for example, if you have wages, this is a typical scenario, if you have wages because you have a regular job, and then you have a rental property, and that rental property is profitable, then you're gonna have wages, and that's earned income, and then you're gonna have rental income, and generally, that's going to be passive income that's not subject to Social Security and Medicare tax, okay? You're not gonna be subject to Social Security and Medicare tax on your rental income if it's a passive rental, right? You just have month-to-month tenants in there. We're not talking about something where it's like an Airbnb that's reported on the Schedule C. I'm just saying you have a Schedule E rental and it's passive. Then you have the wages, which is earned income, and then you have the rental, which is passive income. The wages are going to be subject to Social Security and Medicare, okay? Those taxes, plus income tax on top of that. Now, the rental income is not subject to Social Security and Medicare tax because it's passive. It's not subject to Social Security and Medicare tax, but it's going to be subject to income tax. And those two, the rental income and the wages, are ordinary income, okay? So you're going to be taxed at ordinary income tax rates on both of those income sources. Now, the time where you get a beneficial tax rate is from capital gains and qualified dividends. Capital gains is when you sell like stock or cryptocurrency, or even something like a collectible, like we discussed in the introductory webinars. The collectibles are taxed at the highest tax rate for a collectible is 28%. So let's say I'm a person who makes $1 million in wages, then I'm going to be at the highest tax rate. That's my ordinary income tax rate. It's going to be the highest tax rate because I made $1 million in wages. But if I have capital gains, then that is going to be taxed at a lower maximum rate. It's going to be taxed at 20% is the maximum rate. So I'm going to have two tax rates there. Ordinary is my wages, and then the capital gains from selling stock, let's say, is going to be a maximum of 20, which is why everybody wants capital gains, because it's a beneficial tax rate, even if you're at a higher income tax rate. And wealthy people think about that a lot, right? Because usually they're maxed out. And by maxed out, I mean they're at the highest tax rate. So they look for ways to get creative and try to lower that. And many times you can't lower that because you're phased out for all the deductions and credits. But one of the ways to actually lower is by having sources of income that are taxed at a lower rate, like capital gains. Okay? All right. Now, unearned income is everything other than earned income. That could include interest, like that you receive from a CD on your bank account, something like that. Dividends can be qualified and ordinary. All right, dividends are what you receive because you own stock in a corporation. Like, for example, if you own stock in Coca-Cola or Apple, sometimes they will issue dividends. And many people who are retired, they will use dividends as a second source of income in addition to their Social Security. They're not working anymore, but they want to have money coming in. So you can have dividends coming in, and that's considered unearned income. It's considered portfolio income. And we're going to talk about that. I talk about this when we talk about rental income. Portfolio income is something like interest and dividends. You're receiving that from your portfolio, okay? Retirement income, which is considered pension income. Retirement income would be something like you're receiving a pension because you worked for the federal government, or you're a teacher, you're receiving a pension from CalSTRS or CalPERS or whatever they call it. That's retirement income. Taxable alimony, if it's a situation where it's a grandfathered divorce decree and it's taxable alimony, you still got to pay tax on it. There are people who have grandfathered divorce decrees that were issued before the Tax Cuts and Jobs Act changes came into effect, where they still have to pay tax on their alimony, and then the person who is paying the alimony still gets to deduct it, okay? And then disability benefits. Now, there are some types of disability benefits that are taxable and some that are not, and that's what we're going to cover in this chapter, okay? Now, investment income and other unearned income is generally not subject to FICA, payroll, or self-employment tax. Now, this is all the same tax. This is all the same tax. For you payroll gurus out there, you know this, right? So the FICA, the payroll, the SE tax, that's all the same tax. That's all Social Security and Medicare, okay? And most of the time, unearned income is not going to be subject to Social Security and Medicare. The amount of taxable income is used to determine the taxpayer's gross income tax liability before applicable credits. Constructive receipt of income. Now, the doctrine of constructive receipt is a legal doctrine, and it requires that cash basis taxpayers be taxed on income when it becomes available and is not subject to substantial limitations or restrictions, regardless of whether it is actually in their physical possession. Now, the rules are different when you have an accrual-based business, but most taxpayers, individual taxpayers or natural persons, humans, are on the cash basis. Income received by an agent for the taxpayer is considered constructively received in the year the agent receives it. If there are significant restrictions on the income, or if the income is not accessible to the taxpayer, it is not considered to have been constructively received. According to the IRS, constructive receipt requires that an amount credited to an individual's account be subject to unqualified demand. This sounds more complicated than it really is. Basically, when they're talking about an agent, it means that, like, for example, if I have my brother go pick up my checks, like say, go pick up my checks from my renters, they need to pay rent, and he goes pick up the checks. I can't say, well, I didn't get that money, because my brother would be my agent, right? He's picking up the money for me, so it's my money, and he got it, so now it's taxable to me as soon as he gets it. The agent. If someone picks up money for you, like an employee picks up checks from a vendor, or you pick up a rental check when you send somebody else to go get it, that's your agent, and it's taxable to you as soon as they have it. Now, significant restrictions thing That gets litigated pretty frequently with the IRS, and this sometimes is a gray area, but I'm going to give you some examples so you understand. Now, let me give you an example of where there is a legal gray area when it comes to the doctrine of constructive receipt. This actually happened. This example is loosely based on a PLR. The PLR number is there at the bottom of the example. A PLR is a private letter ruling, and this is when the IRS gives specific advice to a taxpayer on something that happened, some kind of an event. PLRs are not free. They're they're very expensive. They cost a minimum of $10,000. So this is not something that you would do unless you had a very good reason. But in this case, the taxpayer wanted to know when constructive receipt actually occurred. Because in order for constructive receipt to occur, you have to have control over the funds that you presumably receive. But even that can be a legal gray area. Okay. So example, Penny owns a large plot of land in Chicago, Illinois. On January 2nd, 2024, the county filed a condemnation action to acquire Penny's land in order to build a public highway. And we talk about this in part 2 as well as part 1. This can actually affect anybody. This is called eminent domain, or it's a condemnation, and it's when the government wants to take 800,000 is like in quotes, because they didn't want to fight her. The government just wanted to take her land without a court battle, right? So they're like, well, we're gonna put $800,000 over here with the state treasurer. You can have it if you want it, right? So they deposited this money, $800,000 for the property with the Illinois state treasurer. Penny could have withdrawn the funds at that time. So that's where the legal gray area comes in. Because she could have taken that $800,000 when they initially deposited that probable compensation for her land. But if she would have withdrawn the funds, it would have jeopardized her ability to sue. And she doesn't want to sell her land, right? So she didn't take the money out that they had deposited as probable compensation, right? This is all like legal wrangling. But do you understand that she could have withdrawn the money at that time? On June 4th, 2024, a little bit later in the year, Penny files a lawsuit against the county, challenging the government's right to take her property. Penny eventually settles the lawsuit, right? They wear you down, and they wore her down too. So she eventually settles the lawsuit. Hopefully she got more money out of them by doing this. But she eventually settles the lawsuit, but not until the following year. Penny finally accepts the condemnation award for her property on March 31st of 2025. So the following year is when she actually land. She didn't want to sell her land. A condemnation or eminent domain, that's a forced sale. That's when the government gives you money for property that you don't want to sell in the first place. And she wanted to fight it. So this is a situation where there's a gray area with regards to constructive receipt. Okay, so that's why I say this gets litigated a lot. And in this case, the IRS determined that she actually had constructive receipt in the following year when she finally settled her case with the county. Example number 2. Karen won front row concert tickets valued at $1,200 from a local radio station. The value of the tickets is clearly printed on the tickets. Karen would be required to pay taxes based on the fair market value of the tickets. However, on the day of the concert, the radio station does not receive the tickets in time from the promoter, and Karen is not able to attend the concert. Since she never received the tickets, the prize is not taxable to her because she never had constructive receipt of it. Sometimes they'll still receive a 1099 for this. They won something, but they never got it. They never got the prize winnings or the tickets or the money. If that's the case, then you can argue that the taxpayer never had constructive receipt of the funds. Usually if that happens and they want to make that kind of an argument, then I personally, this is me, if they have received a 1099 for it, but they never received it, then I will add it to the return, I will back it out, I will add it, back it out, and then I will attach a disclosure statement to the return. And we talk more about that in part 3, because this is like rep work that you do. It's something that you would do on behalf of the taxpayer. And basically you're making a statement, or you're attaching a statement to the tax return in order to notify the IRS in advance that there's an issue with the taxpayer's wage and income statements, that income that was reported to them is not actually their income, or that they never had constructive receipt of the income. Sometimes it's something as simple as a timing difference, but there's ways to not report it where it's legal and you're notifying the IRS in order to avoid problems later or notices later. Okay, the claim of right doctrine. A claim of right occurs when a taxpayer reports income as being taxable in 1 year, but then has to repay more than $3,000 of that income back in a future year. This is a situation where you received income 1 year and then you have to pay it back in the following year. And if you're self-employed, then you just deduct it in the following year. You don't have to amend, is what I'm saying. The tax treatment differs, but you don't have to amend if it's a Schedule C taxpayer or a Schedule F, right? They have a business. Then what you do is you reduce the income in the year that the amounts were repaid. And the best way to do that is you put it right on the returns and allowances line. There's a line on the form in order to put amounts that had to be repaid in the following year, and that prevents issues with like a 1099 mismatch. You put it in the returns and allowances line as if you gave the person a refund, which is what it usually is most of the time if you have a self-employed person. You're giving them a refund, or the amount of the 1099 is overstated because maybe the purchase happened 6 months ago or a year ago, and now you have some legal issue where you have to repay this person back, and you have to do it in like the form of a check. So you would reduce the amount of income in the following year where you issued the refund or whatever it was. That's if it's a self-employed taxpayer. Now, if the income that was previously reported as wages or taxable unemployment compensation or Social Security or some other non-business income, then the tax treatment is different and the taxpayer is at a big disadvantage, because many times then the repayment is not deductible. They still had to pay tax on the money in the prior year, but then they can't deduct it anywhere in the current year or the year of the repayment. So I've had multiple people ask me about this exact scenario this year, just in the last few months. I mean, at least 3 or 4 where they've had to repay amounts in this year that they were paid in the prior year, and now they want to know where they can deduct it. And many times they can't. If it's this type of income, if it's wages, unemployment compensation, Social Security, that sort of thing. If there's a dispute and the income is later repaid, the repayment is not deductible in the year it is repaid unless the repayment is over $3,000. And if the amount repaid was $3,000 or less, the claim of right under IRC section 1341, this is where you would find out about claim of right. This is the code section. And then it's also in the IRS publications, and you would look in IRS publication 525 under repayments under claim of right. That's what it's called.
The next webinar covers income for self-employed taxpayers. In this webinar, we cover self-employed taxpayers.
Self-employed taxpayers are taxpayers who work for themselves. They don't have an employer and they have a business. A taxpayer who has self-employment income of $400 or more in a year must file a tax return and report the earnings to the IRS. It's $400. It's not $600. $400 is the threshold where the self-employment tax kicks in. And if you don't believe me, create a tax return in your software and put $399 on the Schedule C. And you will see that no Schedule SE will be generated. $400 is the amount where it triggers the self-employment tax or the Social Security and Medicare. And to me, this seems just like a random number that Congress chose. I don't know why it's not 600, why it's 400, but it's 400. Now, 600 is the threshold where you have to file a 1099 for someone, like a contractor. These thresholds are not related to one another. The $600 threshold is not related to this threshold where a self-employed taxpayer has to file a Schedule C. It's not the same. But if you have a person who is self-employed and they have self-employment income of $400 or more, then they have to file a tax return and report the earnings to the IRS. And this will trigger a tax return filing regardless of whether or not they have any other income sources anywhere else. So if you have like $2,000 of self-employment income, and you get like a 1099 NEC for that income, and you have no other income from any other source, you are still required to file a tax return. And you won't be subject to income tax, because remember, the standard deduction amount takes care of that. But you will be subject to self-employment tax, which is the Social Security and Medicare tax, because of your earnings. Because self-employment tax is triggered at $400 of income. So it's a special filing requirement that applies to self-employed taxpayers. 400 is the trigger, not 600. Now, taxpayers who are independent contractors usually receive the Form 1099 NEC. NEC stands for non-employee compensation. And this is an old form that was retired in the 80s. I think 1982 was the last year that it was used. And then what happened in the interim between the 80s and now is everybody used the 1099 miscellaneous to report non-employee compensation, and then the IRS brought it back. So the 1099 NEC is not a new form. It's an old form that was brought back. And now this one is just used for non-employee compensation. And the 1099 miscellaneous is like a dumping ground for all other types of miscellaneous income. The amounts that are reported on Form 1099 NEC, along with any other business income, are reported by most self-employed taxpayers on Schedule C, profit or loss from business. Self-employed farmers will report their earnings on Schedule F. So the Schedule C is for self-employed taxpayers, and then the Schedule F is specifically for farmers. It has special lines for like things that farmers would deduct, like feed and for their animals and soil conservation expenses and that sort of thing. Like the expenses are not the same, obviously, that you would see on a Schedule C. But the Schedule F is also for self-employed people. It's just you've got to be a farmer to use it. Now, this is the 1099 NEC for non-employee compensation. As you can see, it doesn't have a year printed on it anymore. The IRS made this a continuous form last year or the year before, where you would actually, your software is going to type in the form here, and it doesn't actually have a year anymore. So the IRS is only going to revise this when they need to, and from here on out, it's going to be continuous, where you're going to write in the calendar year or put in the calendar year with your software right here. Now, self-employment income is income that you receive from being self-employed. You have your own business. It also includes income of ministers, priests, and rabbis for the performance of services such as baptisms and marriages. This is also considered self-employment income. And we have only a very small section on clergy, the taxation of clergy. There's a lot of special rules that go along with the taxation of clergy. I have done payroll for a church, but I don't do any clergy returns at this point. And if you want to learn about the rules for clergy, read that section in the book, but just realize that there's a lot of special rules for clergy. There are some tax professionals that specialize in clergy. So I even belong to a Facebook group run by an enrolled agent called Michelle Brown, who has a Facebook group for clergy, taxation, and bookkeeping. And if you have a Facebook account, I suggest that you join it. So there's good information there if you want to learn about this kind of specific taxation, because there's special rules for them. Self-employment income also includes the distributive share of trade or business income allocated by a partnership to its general partners. The income is reported to the individual partners on Schedule K1 of Form 1065. Now, we talk about partnerships a lot more in Part 2, but an individual partner, like a human, that's a partner in a partnership, is going to receive money from that partnership or distributive income from that partnership, and you have to know how to report it on their individual tax return. So it obviously affects individuals. Partners in a partnership, if they're general partners, are considered self-employed. The self-employment income is reported to them on the Schedule K1, and then that goes on the Schedule E. Page 2 of the Schedule E, that's where it goes. That's where the distributive share of S corporation income also goes, but that's where it gets reported, okay? And partners in a partnership are considered self-employed. Shareholders in an S corporation are not self-employed. They're employees of the corporation, but partners in a partnership are considered self-employed. There is a very distinctive difference between the two. okay? If you are a partner in a partnership, you're self-employed, okay? Unless you're a limited partner. Limited partners are just investors, and they're not considered self-employed. But general partners in a partnership are considered self-employed, and the income that they earn from that partnership is subject to self-employment tax. Okay, they have to pay self-employment tax on their earnings. If you're a shareholder in an S corporation, you're an employee of that S corporation, and you're not self-employed, which sometimes can make a big difference, because partners in a partnership can deduct UPE, which is unreimbursed partnership expenses, on the Schedule E, just like a self-employed person can. And shareholders in an S corporation can't do that because they're employees of the S corporation. They're not partners in a partnership. Very different tax treatment there. A taxpayer does not have to conduct regular full-time business activities to be considered self-employed. A taxpayer may have a side business in addition to a regular job, and this also can be considered self-employment. Like, you can have a side gig in addition to your regular wages, and many people do. Okay, self-employment tax. The self-employment tax is imposed on self-employed individuals in a manner similar to the Social Security and Medicare taxes that apply to wage earners. It's similar because it's the same tax. It's just that when you're self-employed, you got to pay the whole thing. And when you're employed as an employee, you only pay half because the employer pays the other half. So it's in a manner similar, it's just worse because you didn't pay more. Self-employment tax is calculated on IRS Schedule SE self-employment tax. The self-employment tax is not calculated on the Schedule C. And that's been like a trick question on past exams. So I think you need to know this. So if you're self-employed, you're going to report your income and your expenses from your business on the Schedule C. But the self-employment tax doesn't get calculated on the Schedule C. It gets calculated on the Schedule SE, right? Which is why if you have a qualified joint venture and it's two spouses filing together, that's why you need to have two Schedule Cs. Because the self-employment tax has to be allocated to each spouse. And if you don't do that, then what happens is one spouse only is going to get all of the Social Security tax and Medicare tax allocated to them, and the other spouse is going to get nothing. So then when they go and they file for Social Security, the other spouse that gets nothing, which is actually usually the wife, is where I've seen this scenario happen, that she will notice, hey, I've been running a business with my husband all these years, we've been filing together, but everything's been reported on one Schedule C, and my husband gets all of the self-employment tax, and I got nothing. My Social Security account looks like I have nothing. So I've heard that happen on more than one occasion. And one lady actually, this is when I was working for a CPA firm, she had like some old-timey tax professional, tax preparer. It was a partnership. It was a husband and wife partnership. They were running a restaurant together, and they'd been running this restaurant together for years. Instead of filing a partnership tax return, because the guy was lazy, he filed one Schedule C for the husband. Never put the wife on, but she was signing the tax returns because it was a joint return, but they were running this business together. She worked in the business all these years. They only filed one Schedule C. Then the husband dies, and the wife gets to retirement age, and she goes, and she pulls her Social Security statement, and it looks like she's never worked a day in her life, because all of the income and all of the self-employment tax was always allocated to the husband. Now, she lucked out because she was able to get survivor benefits, which you can get. You can get survivor benefits under the earnings record of your deceased spouse. So it worked out for her in this case, but she was livid. Like, she went back to the tax preparer and she read him his rights. She's going to sue, right? That's malpractice. If you have a situation where it's a husband and wife or a spousal business, if it's a same-sex couple, right, you don't want to be reporting everything under one Schedule C and one Schedule SE, because the other spouse is supposed to be getting Social Security and Medicare tax allocated to them. And maybe they're not going to think about it too much if they're 20 or 30, but when they get to be 60, 65, and they go to try to collect their Social Security, they're going to be mad about it. I can guarantee that. All right? So Social Security tax is calculated on the Schedule SE, not on the Schedule C or the Schedule F, if it's a farmer. Now, if you have a taxpayer who has more than one business, like they have two businesses, then you net the profit or loss from each business to determine the total earnings subject to SE tax. And this is true even if it's someone like, let's say I'm a partner in a partnership, I'm a general partner in a partnership, and I'm making money from that activity. And then I also have a Schedule C business on the side. So I have, let's say my tax business is a Schedule C tax business, and I'm self-employed, but then I have, I'm a partner in a partnership that's doing publishing, or, runs a car wash or a restaurant or something else like that. Then the self-employment income from the partnership plus the self-employment income from the Schedule C business, my tax practice, will come together to net, and then the total earnings will be subject to SE tax. Now, if it's just me, and I have, let's say, losses from one business and then profit from the other, then the losses will offset the profit as well in order to lower my SE tax. Now, if it's married taxpayers, though, married taxpayers cannot combine their income or loss from self-employment to determine their individual earnings subject to SE tax. Because each individual human, each person, has their own Social Security and Medicare account. And just think about it in terms of wages. Like my husband's wages, we might file a joint return together, right? And then all of our gross income gets lumped together on a married filing joint return. Our gross income gets lumped together. And that's true whether we have a business or whether we're wage earners. But the wages that he earns, let's say his wages on his W-2, he gets Social Security and Medicare tax taken out of his wages. That's his Social Security and his Medicare tax. It goes into his Social Security account. Now, me, let's say I have my wages. My wages are also going to be subject to Social Security and Medicare. That amount of Social Security and Medicare tax goes into my Social Security and Medicare account. That's separate. The Social Security and Medicare that we pay, it's separate. Mine is mine and his is his. Okay? That's the same for self-employed taxpayers. If I have my own Schedule C business that's just mine, not a qualified joint venture, let's say my tax business, I'm reporting that on a Schedule C. And let's say my husband has a business too, and he has his own Schedule C. Then if one of us has losses and one of us has profits, the profits from my business will not net his losses to calculate my self-employment tax. They'll net each other for income tax purposes, but I will have to pay self-employment tax on the full amount of my earnings, just like I would have to pay Social Security and Medicare tax on the full amount of my wages if I earned wages. Got it? Okay. Now, not all income that's reported on the Schedule C is going to be subject to self-employment tax. There's some oddballs out there. The one that is most notable, I think, is notary income. So these are covered in the pubs. There's a few exceptions to the normal rule. 99% of the time, if it's income that's reported on a Schedule C, it's going to be subject to self-employment tax. And a Schedule SE will also be generated by your software. But there's actually a little box that you can check in your software where you check it and say this income is not subject to self-employment tax. The one that you might see the most often is notary income. And this might affect you as well because many tax preparers are also licensed notaries. The fees for services that you provided as a notary public are not subject to self-employment tax. This is right out of the pubs on the IRS website. However, all of your other self-employment income is subject to self-employment tax. And they give you an example. If you're a notary, then the fees that you receive for notarizing documents specifically, like for actually putting the stamp, your notary stamp on a document, those are not subject to self-employment tax. And all your other fees would be, but the notary fees specifically would not be subject to self-employment tax. The way that I usually do this is, I used to be a notary too in California. I let it lapse because I didn't do very many, but I would just split my income, for the little couple $100 that I received in notary fees, and I would file 2 Schedule Cs. So the majority of my income was from the tax preparation and bookkeeping services that I provided. That would be on the one Schedule C. And then the other Schedule C would be the notary fees, so that I could actually check the box and say that this isn't subject to self-employment tax. That's the easiest way that I found to do it. Maybe you found a different way to do it that's easier than that, but I could never manage to find a better way to do it than that. So the fees that you provide as a notary public are not subject to self-employment tax, but any other self-employment income that you would receive in addition to the notary fees. For example, if you're like a loan signing agent as well as a notary, then only the fees that you provide as a notary public, that wouldn't be subject to self-employment tax. But any of the other fees would be. Now, let me give you a few examples of how it works when you have a married couple with two businesses and a sole proprietor, one individual with two businesses, how it works on the self-employment tax side. So Brian is a sole proprietor who owns a barbershop. He has $49,000 of net income from the business. His wife, Ellen, has a candle making business, which has overall losses of $12,000. So Brian's business is doing well, and Ellen's business is not doing so good. So he has profits, but she has losses. Okay. Now Brian must pay self-employment tax on the full $49,000. So if he had $49,000 in wages, then he would be paying the full Social Security and Medicare tax on his wages, the full $49,000. And that's the same if you're self-employed. He has to pay the full amount of self-employment tax on the net. And this is regardless of how he and Ellen choose to file, whether they file a joint return or whether they file two separate returns. And this is because married couples cannot offset each other's income from self-employment, even if they file jointly, for self-employment tax purposes. Now, for income tax purposes, her losses will offset his income. So their income tax will be lower if they file jointly. But they can't offset each other's self-employment tax because it's just like the Social Security and Medicare tax that you might earn on your wages. It's per individual. Okay, so he has profits. He's going to have to pay tax, self-employment tax on the full amount of his profits. Okay, now this is a second scenario. Now this is a situation where you have one person that has two businesses. So this is not two individuals, each with their own business, like a married couple where one has a business and the other has a business. One has losses, one has profits. This is a situation where you have a sole proprietor that has two separate sole proprietorships. So Billy is a married taxpayer who is a sole proprietor of two small businesses, a computer repair shop and a car wash business that he only runs during the summer months. Billy's wife is a homemaker and does not work in either business. So she is not working in his business. This is not a qualified joint venture scenario. Okay, it's just him. He's the only one who has a business. And Billy's computer business has net income of $50,000. So the computer business has profits. The car wash has a net loss of $23,000 for the year. Billy only has to pay self-employment tax on $27,000 because the $50,000 profits on one sole proprietorship will offset the $23,000 losses on the other sole proprietorship because he's the owner of both businesses. It's just as if he had one business in that case where the income is going to offset those losses. He can net the income and the losses from both of his businesses, and he will pay a lower self-employment tax. He'll only pay self-employment tax on $27,000. Now, you might ask, why doesn't he just file one Schedule C and make it easy? Well, you're not allowed to do that. You're not allowed to do that. The IRS doesn't want taxpayers who have very distinct separate businesses. Now, sometimes businesses will be related, right? You can have a computer repair shop and then also maybe sell computers or sell like cell phones on the side or whatever. That would all, to me, that would seem like all the same business. But a computer repair shop and a car wash are pretty different businesses. The reason why the IRS wants you to report two separate businesses, if it's a sole proprietorship, on two separate Schedule Cs is because they don't want people taking a profitable business and offsetting something that might be a hobby that has losses, which a lot of wealthy people try to do. I will tell you that. They try to do it. This gets litigated a lot, especially if you have a person who is wealthy and wants to either race cars, seems to be like a car racing thing, car racing business. They all want to race cars, right? So they have like a really profitable business, and then they'll file a Schedule C for their car racing activity. But the car racing activity like just loses money, like gangbusters every single year. And that's because it's a hobby. They just like racing cars, but they want to somehow make it deductible. So that's one. And then also people who will sometimes they will raise and race horses like thoroughbreds. Although the people that actually race horses and have like a horse business, they do a lot better in the tax court. So the IRS tries to go after them all the time, and the IRS tends to lose against the horse people. I don't know why. I think that the tax court just loves horses. I don't know what it is. They also get, if it's a horse activity, specifically horses, not just general farming, but specifically horses. For whatever reason, the hobby law's safe harbor rule for horse activities is they only have to make a profit 2 out of the last 7 years. But everybody else, they want you to make a profit 2 out of the last 5. That's the safe harbor. That doesn't mean that if you have a business that loses money for 5 years or 10 years, that you can't argue that that you have a profit motive in the tax court. It's just that the IRS is going to try to maybe reclassify it as a hobby. Okay, but that's the reason. It's because of the hobby loss rules why the IRS doesn't want you to file everything on one Schedule C if you have 2 separate distinct businesses. It has nothing to do with whether or not, the income can offset each other. Yeah, they do. If you have one person that has more than one sole proprietorship, if 2 Schedule C businesses, the losses from one business will offset the income from the other. But the IRS still wants you to report it separately. Because if you have losses on one business year after year after year, the IRS might want to reclassify that as a hobby. They don't always win. And, Amazon lost money for 20 years. And I don't think Jeff Bezos ever had to go in front of the tax court and tell him, hey, I have a profit motive in Amazon, right? Right? It's easier for the IRS to audit a taxpayer who has like maybe profits on one Schedule C and losses on the other. That's an easier reclassification than a situation where you have like a much larger business, like a corporate entity that has losses year after year after year. And then they have, good lawyers and CPAs and other tax accountants working for them in their own internal auditing. It's more difficult to squeeze money out of them than it is, a Schedule C taxpayer who might be trying to be a little bit tricky and deducting their little car racing activity as a business loss to offset the income of their actual profitable business, which people try to do all the time. But the rule still stands that if you have a taxpayer and they have more than one business and it is a bona fide business, like a car wash and a computer repair shop, like in this example, if one of the businesses is profitable and the other one has losses, then those will net each other for income tax purposes and self-employment tax purposes. But if it's a married couple and they each have their own business, then one couple's losses can't offset the other's profits. Not for self-employment tax purposes, only for income tax purposes. The next unit covers employee compensation and worker classification. In this video, we cover employee compensation and worker classification. Employee compensation and worker classification. Now, we talk a lot more about employee compensation and the types of employee compensation that an employee can receive in part 2, because we talk about it a lot from the point of view of the employer that's offering especially fringe, right? Wages is easy, right? You just pay somebody wages, then it's just wages. It's deductible by the business and it's taxable to the employee. But on the enrolled agent exam, they're not going to ask you about something easy like wages. They're going to ask you something about taxable fringe benefits. What's supplemental wages? When can you deduct this? Da 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 da. So we talk a lot more about employee compensation from the point of view of the employer in part 2. We do cover it in this chapter in the individual's book as well, because you have to realize how different types of compensation are taxable to the employee that's receiving those benefits and how it has to be reported on the tax return. So do read through that portion of the chapter, but I'm not going to rehash the same topics here as I do in the webinar for part 2 on employee compensation, because that webinar is really long. Okay, there's a lot to cover. Wages, salaries, bonuses, tips, and commissions are compensation received by employees for services performed. They're deductible by the business and taxable to the employee on the Form 1040. For federal tax purposes, the IRS classifies workers in two broad categories: employees or independent contractor. If you're an employee, you're not an independent contractor. Employees get a Form W-2. Independent contractors get a 1099 NEC. Okay? These workers are taxed in different ways, and businesses must identify the correct classification for each individual to whom it makes payments for services. Employee misclassification. Now, this is a hot button issue with the IRS. They really don't like businesses that misclassify their workers. Okay? The general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work, not what will be done and how it will be done. Now, the federal guideline is going to be different sometimes than the state guidelines. California passed a law a couple years back called AB5 with regards to employee classification, and that state law is a lot stricter. Okay, California basically wants everybody to be treated as an employee. The federal guideline is not as strict as California's state law, but it's still pretty strict. If a worker receives a 1099 but believes that they're an employee and should have received a Form W-2 instead, there is something that you can do. And this will actually happen throughout your career. You're going to see taxpayers come in that got a 1099 from a business when they should have been classified as an employee because the business was either too lazy to run payroll or because they want to deduct whatever they paid that person, but they don't want to buy workers' comp, which many states will mandate as soon as you hire even one employee. That's not a tax issue. It's a workers' comp issue. It's a state issue, but that has to do with whether or not an employee gets injured on the job. And there's a lot of states that mandate that as soon as you hire one employee, if the employee is not an actual owner of the business. Like, for example, in Nevada, if you have like a sole shareholder S corp, and it's just the shareholder, sole shareholder S corp, and it's just one owner, and that owner is the only employee of the corporation, then you don't have to buy workers' comp. As soon as you hire one person, even if it's the owner's kid, even if it's the owner's spouse, their husband or wife, you have to buy workers' comp. You have to pay for it. And a lot of businesses don't want to pay for it because workers' comp can be expensive, workers' compensation insurance. So a lot of businesses want to just treat their workers as independent contractors. They don't have to pay payroll tax, so they don't have to buy workers' comp, and so they don't have to run payroll. So they don't have to pay you to do payroll for them, or they don't want to pay like Gusto or Patriot to run their payroll every month. Okay, so there's a lot of reasons why they do it, but it's usually a shady reason. It's not for the benefit of the employee or anything like that. But if you do have someone who comes into your office and they have a 1099 and they feel like they should have been a worker, then you don't put in the information from the 1099 on the Schedule C. That's not what you do. You file the Form SS-8, which is a determination of worker status for purposes of federal employment taxes and income tax withholding with the IRS. This is like an atomic bomb for the employer. Like, it's like, hey, IRS, this employer is misclassifying workers. Audit them. It's going to cause an audit of the employer. I'm just telling you this right now. If an employee gets one of these and they're mad because they now owe a bunch of tax that they shouldn't have owed because they got a 1099 when they were really supposed to be classified as employees, and you file this SSA, they're probably going to lose their job because the IRS is going to come in and audit the employer. They're going to audit the business for employee misclassification. And to be honest, the employer usually loses. They usually do. They lose. If a determination is made that they are an employee, they will file Form 8919, uncollected Social Security and Medicare tax on wages with their tax return. So that's what you're supposed to do. It triggers an audit of the employer. Example, Stella was hired to work as a file clerk for a small car wash company. The business classified Stella as an independent contractor in order to avoid having to pay payroll taxes. Stella worked in the office every day from 9 to 5 under the full control of the company and was clearly an employee. Like if they're coming into your business and they're working 9 to 5 in your office and you're controlling everything that they do, then they're employees. They're not independent contractors. The business issued Stella a 1099 NEC at the end of the year. Stella disagrees with her classification, so she fills out Form SS8 and files it with the IRS. The IRS will investigate the classification issue, and if they determine that she was an employee, they will make sure that her employer pays the payroll taxes that were their responsibility, and Stella will just be liable for the income tax on the amount that she has earned, just as if she would have been had she been classified correctly. She would file the Form 8919 with her tax return to account and pay for her share of Social Security and Medicare taxes on her wage. So she would actually owe the tax on the amount that she earned, just like she would as if she was classified correctly. But the IRS will go after the employer for their share of the Social Security and Medicare that the employer should have paid. The employer is trying to get her to pay self-employment tax, but that's not how it's supposed to go. When you're an employee, the employer is supposed to pay half of the payroll taxes and the employee pays the other half. So Stella will still be responsible for paying what she would have owed if she actually got a W-2 the way she should have. But the IRS will go after the employer for the rest. Terrence works for a company as a delivery driver. At the end of the year, Terrence's employer issues him a Form 1099 NEC instead of a Form W-2. Terrence believes that he was misclassified as an independent contractor. While he completed and filed the Form SS8 with the IRS, he has not yet received a response from the IRS by the tax return due date. Therefore, he files Form 8919, uncollected Social Security and Medicare tax on wages with his tax return. Terrence lists the name of the employer, provides the employer's federal employer identification number, which he can get from the 1099 that they issued to him, the reason he is filing, and his total alleged wages with unreported Social Security and Medicare taxes. And once again, this is going to trigger a misclassification audit of the employer. And usually the employer loses. The employee will actually win. Tip income. So tips are considered earned income. They're eligible for the earned income tax credit. You can use the amount that you receive in tips in order to put money into a traditional or a Roth IRA. It's earned income. But there's some specific rules that go along with tip income that don't apply to other types of income. So tips received by food servers, baggage handlers, hairdressers, and others for performing services are taxable income. An individual who receives $20 or more per month in tips must report the tip income to his employer. So this is the threshold that I think you need to remember for the test. It's $20 or more per month, which I think is really low. But if you receive $20 or more per month in tips, then you have to report that tip income to your employer. It has to be added to the W-2. Now, some employers don't want to deal with this at all, especially if it's an employer that's not part of the restaurant industry. They don't want to deal with having to add the tips to the Form W-2 and the extra accounting that goes along with that. So they will just say, you're not a tipped employee and you are not allowed to accept tips. Okay. Many employers will do that, and they'll make it part of their company policy that the employees are not allowed to accept tips. And then if the employees do accept tips, then they have to report them on their tax return as earned income after the fact. I'm just telling you what happens in real life. Like, many employers don't want to deal with this. Obviously, in the restaurant industry, tips are too commonplace, and every restaurant will do allocated tips to the servers. But sometimes if it's a business that's not a restaurant, they don't want to deal with this sort of thing. And they'll just say, you're not allowed to accept tips. So then if the employee does accept tips, they have to report them on their tax return using a special form. Form 4137, Social Security and Medicare tax on unreported tip income. And then they have to pay additional tax on that, which I'm sure everybody does. Everybody's really honest about it, right? Okay. But so it's $20. That's the threshold per month where you have to report the tip income to the employer. An employee who receives less than $20 per month in tips does not have to report the tip income to the employer, but they still have to report the tip income on their return. And people get confused by this. Usually, just regular taxpayers, they hear what they want to hear when they're reading something about taxation, and they'll say, "Oh, if you make less than $20 in tips per month, you don't even have to report that." Or if you make less than $100 in tips per month, you don't even have to report that. No, all tip income is reportable. It's all taxable, even if it's just $1. You got to find some way to put it on the return. But if it's less than $20 per month, then that doesn't have to be reported to the employer, but it still has to be reported on the tax return. Just remember this threshold for the test. You might see it. So tips of less than $20 per month are exempt from Social Security and Medicare tax, but are still subject to federal income tax. If you get non-cash tips, for example, something like concert tickets or other items, they do not have to be reported to the employer, but they must be reported and included in the taxpayer's income at their fair market value. So if you're working at some restaurant, and somebody hands you like concert tickets, or like free concert tickets, or free baseball tickets or whatever, if you accept them, you have to include them in your income at their fair market value, even if you don't go. So normally you just, no, I don't want your concert tickets. I don't want your baseball tickets, because I do not want to have to report them at their fair market value on my tax return. The next webinar covers fringe benefits.
Lions in Africa. We don't know why they do this or when it even started. But we have theories. First of all, lions are cats, and cats can climb off principal. Problem is, they're not leopards. And being bulky enough to bring a buffalo to its knees means you probably have no business being in the trees, especially since bigger lions, especially males, run the risk of falling out of the tree and dislocating something. That's a career-ending injury for a lion. The lions in Queen Elizabeth, I mean Kazinga National Park in Uganda, have been seen defying convention and chilling in the trees. And it's like a cultural thing. Most lions only do it from time to time, but in this park, it's a pastime for the whole pride. Like to the point where you can look up and see entire families in the trees. Mind you, there's nowhere else in the world where you get this picture. And again, we have no idea why only these lines in particular do it. Some say it's to avoid the heat, others say branch camping helps them block prey. But the theory I'm stamping is that the Ishasha lines do it to escape insects. You see, in 1963, a heavy rainstorm drove them up the trees, because that rain also brought a plague of insects, insects that would open wounds and cause infections. So what I'm thinking is, those lines figured out they could reject the jihad of flies by learning how to climb, and then their cubs did it, then their cubs, and then, well, isn't that how you end up with culture? Now, the problem is that culture is dying, and it's estimated there's less than 40 tree-happy lions alive. The big problem is poaching. Alex Brashkowski has been studying them for like a decade, and in 2018, 11 of the lions he was studying were poisoned. 8 of them were cubs, and if you watched the previous video, that was Jacob's family. Now, all my homies hate poaching, but hear me out. It's not always pure evil. Uganda's one of the poorest countries in the world, and farmers working lines to protect livestock is slightly more understandable when most of the population makes less than $2 a day. So far, the best compromise is compensating them for livestock and lives lost to lions, without also past tensing the cats too. Either way, we're gonna have to lock in, because the thing with culture is, once they're gone, they're gone. The more you know. So there's a small pot monkey got abandoned by his mother, but adopted by the internet. Let me explain. Punch the monkey was born in July. While he's not a cancer, his mother sure treated him like one, rejecting his presence and refusing to acknowledge him. Now, mothers abandoning babies is rare, but it does happen with extreme environmental stress, and especially with first-time mothers. And being born to a first-timer during a bad heat wave meant Punch got wombo comboed right out the gate. But with his mom tapped out, that left a problem. Baby macaques don't just rely on their mothers for security. They literally build muscle by clinging onto her, so keepers rushed to find a replacement. The first substitute was a bunch of rolled-up towels, but eventually someone handed him a stuffed orangutan from IKEA. That faux wave would become his whole world, especially with Punch running to it for comfort every time he'd get bullied, which was a lot. Macaques have pretty strict hierarchies, and they enforce their place in it by bullying anyone under them. Fix your face, we're no better. Now I've seen people saying to report the zoo for letting Punch get done like this, but it's honestly not that much of a the difference is, newborn macaques often inherit their mother's rank. With no mom, yeah, that's tough. Also, there is a chance Punch not really getting to socialize things. He hasn't really figured out the right subordinate or submissive response to a higher rank, which means he gets dealt slightly dirtier. But for everyone ready to dive out this monkey, there's good news. At 7 months old, he's already started spending less time with the plush and more time with his own kind, socializing, getting hugs, and especially grooming. That's a really big thing for creating social bonds. It's the one time you want to see him get groomed. Keepers also say Punch has gotten braver and much more confident about approaching other monkeys. They seem to be coming around it, and if they don't, IKEA donated 33 other O-rings, although I suspect IKEA did that more for IKEA. Basically, it's looking like things are going to be all right for Punch. I just hope y'all don't forget it like pesto or dang. Or you know, a monkey.
Hello.
Okay, I got your timesheet.
Okay.
So let me show you how to do the. All right. Open up a case. Open up a file. Go to
Caleb.
like. Well,
No, not Caleb.
I'll show you how to do the e-filing with Caleb. Okay.
Okay.
Open this file again. Okay. Now, go to View Print. Okay, so you have to put in the missing